On November 5, 2025, the World Gold Council publishes a regional demand update that reads like a routine market note. It states that North American gold-backed ETFs pull in $37 billion through September, one of the strongest runs on record. In a world where access to dollars can be revoked, $37 billion is not just buying gold, it is buying optionality. And if you hold a 401k, an IRA, a pension, or any portfolio priced in US dollars, this changes everything. What if everything you believed about safe assets was wrong? The data shows this is not a story about fear. It is a story about a repeating cycle, how reserve systems behave when geopolitics collides with finance, and how institutions quietly reposition before the public understands the stakes. This unfolds in 4 stages. Stage 1 is liquidity expansion. Credit is abundant, settlement is smooth, and the dominant currency becomes the default pipeline for global trade. Stage 2 is constraint. Debt grows faster than productive capacity, policy becomes more interventionist, and the rules become flexible in the name of stability. Stage 3 is weaponization. Access to clearing, reserves, and payment rails becomes conditional, and the currency system becomes an enforcement tool as much as an economic tool. Stage 4 is reallocation. Institutions do not announce rebellion. They reduce exposure, diversify reserves, and accumulate assets that cannot be frozen with a signature. Throughout the last 100 years, every reserve system has followed the same sequence. The calendar changes, the slogans change, but the stages remain. This is not prediction. This is pattern recognition drawn from a century of monetary events, balance sheets, and capital flows. In September 1931, Britain suspends the gold standard. The world does not see a technical adjustment. It sees a confession that even a leading financial power can be forced to choose between defend-the-peg discipline and domestic survival. Within months, sterling weakens sharply, trade relationships reprice, and the perceived permanence of monetary promises dissolves. The consequence is not only a lower exchange rate, the consequence is a new understanding of risk. Convertibility is not a law of nature. That is stage 2 becoming stage 3 under pressure. Constraint turns a rule into an option, and the system adapts. What happens next is the part that repeats across history. Institutions do not wait for the next headline. They move toward what is harder to devalue, harder to block, and harder to politicize. Gold becomes less about yield and more about settlement independence. It becomes a reserve asset not because it is fashionable, but because it is outside the administrative reach of another capital city. When the promise behind money becomes negotiable, the asset behind the promise becomes the story. 4 decades later, the same cycle reappears at a larger scale. On August 15, 1971, the United States suspends the dollar's convertibility into gold, ending the core mechanism that anchored Bretton Woods. The mechanics are technical, but the meaning is direct. A claim on the reserve currency is no longer a claim on metal at a fixed price. The same pattern, same stages, same outcome. Stage 1 is visible in the post-war expansion, trade growth, deepening capital markets, and the dollar at the center of settlement. Stage 2 appears as the system strains under persistent imbalances and growing domestic commitments. And then Stage 3 arrives, in a softer form than sanctions, but with the same essence. The issuer asserts the right to change the rules unilaterally. Stage 4 follows as a slow reallocation. Gold does not vanish from the story. It returns as a measuring stick of credibility, an asset that reflects confidence when the formal anchor is removed. The timeline varied, but the sequence did not. Then the modern trigger arrives, and it is sharper than the 20th century versions. In February 2022, roughly $300 to $330 billion of a major central bank's reserves are immobilized abroad, blocked from use when access is revoked. That is stage 3 in its purest form. Reserves exist on paper, but they do not function in crisis. The lesson spreads globally without speeches. If reserves can be frozen, reserve strategy must change. This is why sanctions insurance is not a metaphor. It is a portfolio design problem for states and institutions that measure risk in failure modes. And once that mechanism is demonstrated at scale, Stage 4 becomes a continuous process. 3 monetary shocks, nearly a century of history. Identical 4-stage cycle. Now, apply the cycle to the present day, and the numbers stop feeling academic. On January 29, 2026, the World Gold Council's annual demand report records a breakpoint. Total gold demand in 2025 exceeds 5,000 tons for the first time. In value terms, that demand totals $555 billion, the highest on record. That is not a marginal trade. That is sovereign-scale and institutional-scale reallocation. The same dataset shows an average Q4 gold price of $4,135 per ounce, a record quarterly average. It also notes that the LBMA PM benchmark sets 53 new all-time highs during 2025. When a market makes new highs repeatedly, the easy narrative is speculation. The more important narrative is persistence, who is buying, and why the bid does not disappear. The official sector continues to accumulate. Central banks purchase 863 tons in 2025, still historically elevated even after moderating from the extreme pace of recent years. Those buyers are not chasing quarterly performance, they are building resilience. In Q4 2025 alone, net central bank demand rises to 230 tons. The pattern shows not a one-off reaction but a structural preference. And now the title becomes real. Because while official buying is the backbone of the shift, the visible front edge is what happens inside Western portfolios. North American gold-backed ETFs record $37 billion in net inflows through September 2025. In Q3, U.S.-listed ETFs add roughly 137 tons, and total U.S. holdings rise to around 1,922 tons. That is Stage 4 reallocation expressed in the language of asset management. If you are between 30 and 65 and your retirement is exposed to broad equity indexes, long-duration bonds, or any asset dependent on uninterrupted settlement, this affects you because the system is repricing the value of unfreezable collateral. The cycle is not saying stocks disappear. It is saying the premium on sovereign independent liquidity increases when the world's financial plumbing becomes political. Watch where the reallocation concentrates, and you see the logic behind the move. Poland becomes one of the most visible examples. Over 2025, it adds roughly 102 tons, lifting national gold reserves to about 550 tons. In reserve composition terms, gold approaches roughly 28% of its total reserves. China's reported gold reserves sit around 2,306 tons, and gold accounts for roughly 9% of total reserves. The key number is not the percentage. The key is the direction. Stage 4 is directional. It is persistent. It shows up as repeated additions, not as a single dramatic purchase. Meanwhile, the institutional side keeps building through channels that do not look like geopolitics. They look like diversification, risk management, and hedge construction. In Q4 2025, investment demand is reinforced by large ETF inflows and by bar and coin purchases that surge to multi-year highs. This is a split decision by different kinds of buyers, arriving at the same conclusion. When sovereigns and institutions converge on the same asset class, it is rarely about fashion. It is about a shared definition of risk. To understand why this is hidden sanctions insurance, you have to look at what sanctions actually target. Modern sanctions do not need to seize physical objects. They can block access. They can immobilize accounts. They can constrain settlement. They can turn reserves into unusable entries in a ledger. Gold behaves differently because it can be held outside the liabilities of another state. This does not mean gold is invisible, magical, or consequence-free. It means the failure mode is different. A treasury bond is a claim inside a legal framework controlled by the issuer and enforced through institutions aligned with that issuer. A bank deposit is a claim inside a regulated banking system. A reserve balance is an entry inside a settlement network. In Stage 3, the weak point is not the asset's market value. It is the owner's ability to access it. This is why the shift is not only about price, it is about custody, jurisdiction, and control. The most telling confirmation comes from reserve composition itself. By the end of 2024, gold becomes the second largest global reserve asset by market value, behind only the US dollar, surpassing the euro. Gold rises to roughly 20% of global official reserves, while the euro sits around 16%. That is a structural statement, not a headline. It tells you central banks are not merely hedging inflation. They are hedging governance risk, the risk that access and settlement become conditional. Some will say this time is different because the US dollar remains dominant. The data shows a deeper truth. Dominance does not prevent diversification. It accelerates diversification when access becomes a geopolitical variable. The global system can still run on dollars while institutions quietly accumulate assets that reduce dependence on dollar-based settlement. Stage 4 does not require the reserve currency to collapse. It requires the reserve currency to become politically costly to rely on exclusively. That is what the pattern confirms. Now look forward 12 to 24 months, and the pattern does not demand panic. It demands attention to 3 warning signs. Warning sign 1 is flow composition. When central bank buying remains elevated and ETF inflows accelerate at the same time, it signals a synchronized shift across sovereign and institutional layers. In that environment, a single quarter of strong ETF inflows is not the story. The story is repeated quarters that show a new baseline of demand. Because stage 4 is not an event, it is a baseline change. Warning sign 2 is policy language. When financial restrictions expand beyond individual entities into broader measures that threaten settlement corridors, the incentive to hold sanction-resistant assets increases. This shows up not only in sanctions announcements, but in legislation, regulatory guidance, and enforcement practices that widen the definition of restricted access. The pattern confirms that each expansion of conditional access increases the premium on independent reserves. Warning sign 3 is custody migration. When more institutions emphasize physical allocation, jurisdictional diversification, and repatriation debates, it signals that the fear is not about price volatility, it is about access volatility. If your savings depend on the smooth functioning of settlement systems, access volatility is the risk you cannot ignore. And the practical implication is not extreme, it is structural. In stage 1, portfolios can pretend all liquidity is equal. In stage 3, liquidity is not equal because some liquidity is permissioned. In stage 4, institutions pay for resilience. They allocate toward assets that can survive a fractured system, even if those assets do not maximize yield in calm years. This is not an argument that gold replaces productive investment. It is an argument that gold plays a role that becomes more valuable when the system becomes more conditional. Gold is a reserve asset when the world wants insurance against settlement risk. It is a hedge when geopolitical stress turns financial channels into leverage points. If you are worried about retirement, the lesson is not to chase the price after it rises. The lesson is to recognize what the system is signaling before the next constraint arrives. Remember the 4 stages: liquidity expansion, constraint, weaponization, reallocation. The data shows we are living in late stage 2 and deep stage 3 simultaneously. High leverage, high policy intervention, and a demonstrated willingness to immobilize assets by restricting access. And the flows show stage 4 is already underway. Here is the core thesis in 2 sentences. The World Gold Council's $37 billion inflow signal is not just a market story, it is a governance story. It is capital buying sanctions insurance in plain sight because the precedent of conditional access has already been set. You have a choice. Understand the pattern and position accordingly, or ignore it and hope this time is different. But remember, this time is never different. The pattern is absolute. If this analysis opened your eyes, subscribe now. In my next video, I will map the pressure points, reserve composition, settlement corridors, and institutional flow channels that reveal where the next stress event forms before it becomes a headline. The sanctions insurance shift is happening right now. The only question is whether you will see it before it arrives.